Hello, and thank you for tuning in to Ascending Abundance YouTube channel, where I cover strategies on how to make more money with your capital, investing in real estate, stocks, or crypto, or any other ways of increasing your wealth. There is a firm belief in my mind that the reduction in expenses and a frugal way of living is helpful. It's great. However, it is making more money that's going to make you more abundant and more financially stable than saving every dollar that you make. So with that, I just wanted to take a look at Tesla. That's a stock on everybody's mind. There's lots of news. A friend of mine recently invested in Tesla. I obviously don't have an expertise in automotive industry. I'm just looking at this stock as a short-term potential for an investment. So Googling up Tesla investor relations, I've literally spent like 5-10 minutes doing it. The investor relations page comes up. You go to SEC filings. SEC will show you annual and quarterly reports. Very intuitive. Pick the year, click apply. This comes up. I prefer the PDF, just kind of helps me more. And scrolling down slightly in the table of contents, you will see that financial statements and supplementary data, it's always going to be there. It's always in every company's financial statements. You're going to see that on page 45. So scrolling quickly to page 45, a little over, there we go. So first I want to see the stability of the company. Tesla seems to be quite good from their balance sheet perspective. $82 billion in assets over just $36 billion in liabilities, so it's a quite well capitalized company. And in fact, if we look at their current liabilities versus their cash and cash equivalents plus the short-term investments, then I could see that the current liabilities and short-term investments more than cover the accounts payable as well as the accrued liabilities. So really it's the kind of the long-term debt that we can look at, and long-term debt compared to the overall financial situation of Tesla is pretty low. Just $5 billion plus some little customer deposits, this and that, well covered by all of the other assets. So I'm fairly happy to say that Tesla is by no means in any financial stress. They have so much cash, they're probably going to start either the buybacks or the dividends, or they're just going to ramp up some purchasing of smaller competitors to get the technology access instead of developing it yourself. Keeping so much cash is just not wise in the current scenario of an inflationary environment. Looking at their revenues and how much they're making, I am very much confused by the latest advance by Elon Musk to reduce the price of Tesla by 20%. That's going to hit their revenue, so I just want to model it out. So Tesla has three distinct streams of income. It's automotive in all of its ways, 71 billion out of the total. Energy and storage, just shy of 4 billion, and services, it's another 6 billion. So you could say the automotive is the biggest chunk of Tesla's revenue. The rest of it is just barely catching up. I don't even know what percentage that is, I didn't calculate, but it's clearly the smallest chunk. The biggest is automotive, and if you take out 20% off the price of your vehicles, that hits your revenue. So I want to take a look at what that could translate to in using Excel. So kind of don't pay attention to the rest of it, I'll walk you through. So auto, energy, and services, I just kind of pulled them out of the financial statements, and I say, well, based on what I've read online, analysts, research, nobody quite knows, but Tesla is saying we're going to grow our auto by, say, 50%. Well, I'll use 40% just to be kind of slightly on the safe side. Energy is growing by heaps and bounds, 80 to 90%, so I'll use 80. And then services, I say 50%, just kind of randomly saying it's going to grow probably aligned with all the others. So we're coming up to next year's forecast for revenue of $116 billion, which is great. However, I want to apply the 20% discount on the revenue for the auto because that's what Elon Musk is doing. He's reducing the price of the vehicles. So that would reduce the auto piece by 20%. The rest of them are staying the same. I actually need to make sure that the formula is the same. All right, so that that translates to $96 billion in revenue that I could model out for the next year. Looking at their net income for this year, they made $12 billion. Going back here, this is where the number comes from. Net income, $12 billion, 12 and a half. So the net profit margin, I don't concern myself with all kinds of various ways of EBITDA and NIBIT and margins that you calculate on gross margin and so on. All I care about is how the company makes its bottom line. So net margin 15.5%. If we apply the exact same margin rate to the forecasted revenue, I would get $14 billion for next year. That's an 18% growth rate in net income, 14.8 versus 12.5. Just a pure Excel formula. Compare the two, gives us 18%. So net income growth rate for Tesla could be, if my calculations are in any way accurate, would be 18%. Now, what is Tesla trading at? Last I've seen, price earnings ratio is about 55. So we could calculate PEG ratio, price earnings gross. So we know the gross is going to be 18%. How much of a price earnings are you paying for that future potential growth? It looks like it's a 3. So let's compare the 3 with any other stocks out there. I literally go on Google, say, hey, Tesla PEG ratio, what does that look like? It seems like I'm a bit off. There is Zacks is saying it's 2.12. I don't know as of what date that is, and it's also trailing 12 months. It's not the future. So I'm looking at the future PEG ratio. I'm not looking at the current PEG ratio. Clicking here through various Google searches, like what's Nvidia PEG ratio, what's Walmart's PEG ratio. So Walmart, it says 4.3. Supermarkets is 2.18. So Tesla seems to be trading at a lower PEG than Walmart. What about anybody else? So Costco, this one is confusing. It says it's 2.7, but it operated at 4.5, but it also operated at 188. So median PEG ratio. I don't know what that means. Let's just kind of skip on. What's Coke PEG ratio? 3.6. What is the PEG ratio for S&P 500? This is confusing, so we're not sure. Amazon, 7. What is the PEG ratio for JP Morgan? 178. Okay, so lower PEG ratios than Tesla. Who else could be comparable? What is PepsiCo PEG ratio? 25. Well, that makes no sense. Pfizer, that's actually 0.73, so you're reducing. So it's all over the place, as you can see. The companies that are more stable, like Walmart, or perceived to be, better growth prospects, people are willing to pay higher PEG ratios for them. It doesn't quite tell me a compelling story. What's Goldman Sachs PEG ratio? 12. So it could be all over the place depending on the forecast for the income, depending on how stable do you believe those revenues are going to be, how accurately the market can predict the growth in revenues. There's so many variables that I'm hesitant to say that I understood Tesla in any way. 18% growth rate is definitely great. It's not it's not small, but it hadn't been for these minus 20% in revenues. In profit margin reduction, we would see a 40% growth rate, and that would translate to PEG ratio of just 1.3. That would be amazing. As you've seen, all the other companies that I kind of clicked on Google had a way higher PEG ratio. So this would have been awesome. Minus 20%, I mean, that's just brutal. That's gonna reduce Tesla's net income dramatically for the next year. Now, let's say because of the lower price is going to be a higher growth rate in terms of the manufacturing and sales of vehicles. Maybe they will, instead of 40%, let's say it goes up by 60%. So this little model tells you that now the PEG ratio is 1.7. So if you believe that making this move will increase Tesla's market share and the number of sales they make, then it starts to make sense. So it all depends on what you put in terms of the growth rates and in terms of comparable PEG ratios for other companies. How appealing would Tesla be compared to any other investment? What I can say, it doesn't seem overpriced. Like, it's not a steal of a deal, it's not a bargain, it's not less than one, as ideally, say, Peter Lynch would want to see. And I think he's the one who's used PEG ratio a lot. But at the same time, if the market continues to go the way it is, PEG ratio of 3 seems to be okay. Worst case scenario, you wait a year, the net income grows by 18%. You wait another year, let's say it grows by another 18%. So at that time, you're almost, if you believe the company survives and the competition is going to stay the same and the tax credits and incentives are going to stay the same, the growth rates are going to stay the same. Like, the most you can say is, okay, well, next year the stock is going to be cheaper because it's going to produce all of this growth. But the year after that, if the price does not grow, well, then probably the PE ratio compresses. Then it becomes even cheaper. And eventually, if this continues for 3-4 years and the net income keeps growing, you're just buying that net income at the cheaper and cheaper PE ratios. And at some point, it just stops making sense and the stock rallies. So it all depends on how long can Tesla sustain its growth, how large that growth is going to be. Are they going to screw up? Is competition going to catch up to them? And I have no idea. And that's the key. Anyone can say anything, but unless they're super expert in the automotive industry and trends and consumer behavior and interest rates and who knows what else could derail this market, such as nuclear war with, say, somewhere in the world, I don't want to say the names of the countries, this could all get derailed. So is this a steal of a deal? No. Is it a decent deal? I think so. And it all depends on this growth rate and how many years they can sustain it. So use at your own risk. Wild card, to be fair, and if you are an expert in these technologies and can accurately predict those growth rates, more power to you. There's probably tons of money to be made in Tesla stock in the years to come if the growth continues. Thank you so much for watching. As always, hit the like button, subscribe button, leave me a comment, say hi. Lots of work goes into these podcasts, so I just appreciate the feedback.